Imagine building one of India's fastest-growing technology companies, earning global clients, winning prestigious corporate awards, and becoming a symbol of modern India's economic rise, only for one confession to erase billions of dollars in value almost overnight. At its peak, Satyam Computer Services employed more than 50,000 people. It served hundreds of multinational clients across more than 60 countries. Its software engineers built banking systems, telecommunications platforms, manufacturing software, and enterprise technology used by some of the world's largest corporations. Investors called it one of India's greatest corporate success stories. Analysts praised its consistent profits, customers trusted its delivery, auditors signed its financial statements, the stock market rewarded its growth. Everything appeared genuine, except one thing: the numbers. Behind the impressive revenue, healthy profits, strong cash reserves, and rapidly growing balance sheet, a massive accounting fraud had been quietly expanding for years. Not by a junior accountant, not by an isolated employee, but by the very founder who had built the company from the beginning. For years, the business continued operating. Employees came to work, software was delivered, customers paid invoices, projects were completed. The real business existed, but the financial success reported to investors became increasingly fictional. Each quarter, small accounting adjustments required larger adjustments the following quarter. Fake profits created fake cash. Fake cash required fake bank balances. Fake bank balances required fake interest income. The deception didn't remain the same. It evolved, growing larger, more complicated, and increasingly impossible to reverse. Management found itself trapped inside its own financial statements. Eventually, the fraud became so large that correcting it honestly would instantly destroy everything investors believed the company had become. The only options left were to continue lying or confess. In January 2009, that confession arrived, and with a single letter, one of the largest accounting scandals in corporate history began to unfold. To understand how Satyam's fraud became so enormous, you first need to understand how an IT services company actually makes money. Unlike software companies that sell the same product millions of times, Satyam primarily sold people. More specifically, it sold the time and expertise of software engineers. Imagine a company hires Satyam to build an online banking system. The client signs a contract. Satyam assigns project managers, software developers, quality assurance engineers, database specialists, and technical architects. The engineers complete the work. The client pays according to milestones, hours worked, or long-term service agreements. Revenue enters the business. Employee salaries, office costs, technology expenses, and taxes are paid. Whatever remains becomes profit. The model is remarkably straightforward. More engineers, more projects, more revenue. Higher utilization, higher profits. Because Satyam genuinely employed tens of thousands of engineers, real revenue continued flowing into the company. This is what made the fraud so difficult to detect. Unlike Enron, there were real customers. Unlike Theranos, the company actually delivered working products. Unlike a Ponzi scheme, cash genuinely entered the business. The fraud wasn't that Satyam had no business. The fraud was that management reported a much better business than actually existed. Suppose the company genuinely earned 100 crore rupees in profit. Instead of reporting 100 crore rupees, management might report 120 crore rupees. The additional 20 crores never existed. But once investors believed that extra profit, the balance sheet also had to change. If profits increase, cash should also increase. That meant fake profits required fake cash balances. Then those fake cash balances should earn interest, so fake interest income also had to appear. Every false number automatically created several more false numbers. The accounting system became connected like falling dominoes. One fabricated figure forced another, then another, then another. By the early 2000s, Satyam wasn't simply overstating profits. It had built an entire financial universe where almost every important number depended upon the previous lie remaining hidden. The fraud didn't become massive overnight. It grew because every successful quarter made the next lie more difficult to avoid. Imagine you tell investors your company earned 120 crore rupees this quarter, when it actually earned 100 crores. Next quarter, you can't suddenly report only 95 crores. Investors would immediately ask, what happened? Management, therefore, faced an impossible choice: tell the truth and expose the previous fraud, or report another inflated profit to protect the earlier lie. Satyam chose the second option, again and again and again. This is where the fraud became self-sustaining. Each fake quarter established a new benchmark. Analysts increased future earnings expectations. Institutional investors bought more shares. The company's valuation increased. Employees expected promotions and bonuses. Clients saw an increasingly successful business. The higher the reported success became, the harder it became to return to reality. But another problem quietly emerged. The fake cash balances became enormous. Suppose Satyam reported thousands of crores sitting safely in bank accounts. That cash wasn't just a number. It supposedly belonged to the company. Auditors expected bank confirmations. Investors expected interest income. Directors expected liquidity. Banks expected relationships. Management, therefore, had to fabricate documents, bank statements, deposit confirmations, and interest calculations that matched the imaginary cash. The fraud had now expanded far beyond income statements. It had spread across the balance sheet, cash flow statements, treasury records, and banking documentation. Every department became indirectly connected to the deception. The irony was extraordinary. The real business continued growing. New customers arrived. Employees delivered successful projects. Revenue genuinely increased. But the real business could never grow fast enough to catch the fictional business management had already reported. Every genuine improvement only reduced the gap slightly. The fraud itself continued growing much faster. By 2008, Satyam wasn't simply hiding accounting errors. Management had created an alternative financial reality that had become almost impossible to maintain and even more impossible to escape. By 2008, the fraud had reached a point where the biggest problem was no longer fake profits, it was fake cash. According to Satyam's published financial statements, the company supposedly held thousands of crores sitting safely in bank accounts. To investors, this looked like tremendous financial strength, but much of that cash simply didn't exist. That created a problem unlike anything management had faced before. Fake profits can remain hidden inside financial statements. Fake cash cannot. Sooner or later, someone expects the cash to be used. Imagine telling your family you have $10 million sitting in the bank. As long as nobody asks to see it, the lie survives. But the moment you decide to buy a building, pay a dividend, or invest in another business, the money must actually leave the account. If it isn't there, the lie immediately collapses. Satyam had reached exactly that moment. investors increasingly questioned why a software company was holding such enormous cash reserves. If the company genuinely possessed billions in cash, why wasn't it investing that money? Why wasn't it making acquisitions? Why wasn't it returning more cash to shareholders? The reported cash had become impossible to explain. Raju believed he had found a way out. Instead of leaving the fake cash sitting on the balance sheet forever, he would replace it with real assets. In December 2008, Satyam announced plans to acquire Maytas infrastructure and Maytas properties for approximately US $1.6 billion. Both companies were controlled by Raju's own family. The public explanation was diversification, but financially, the transaction served another purpose. Imagine the balance sheet before the acquisition. Assets included 5,000 crore rupees of reported cash. Most of that cash didn't actually exist. If Satyam successfully purchased Maytas, the balance sheet would change. Instead of showing billions in cash, it would show land, infrastructure projects, construction assets, and property. The difficult question, "Where is the cash?" would disappear. Instead, investors would simply see physical assets on the balance sheet. From an accounting perspective, Raju was attempting to convert a fictional asset into real assets that would be much harder for outsiders to question. It was an attempt to escape the fraud without admitting the fraud. But there was one fatal problem. Buying a real company requires real money. When the transaction closed, banks would have to transfer billions of rupees. The fake cash recorded in Satyam's books could not make that payment, because it had never existed. Investors sensed something was deeply wrong. Why would a software company suddenly buy construction and real estate businesses owned by its founder's family? Institutional investors revolted. Analysts condemned the deal. The share price fell sharply. Within hours, the acquisition was abandoned. For Raju, the failure of the Maytas transaction destroyed the last possible escape route. He could no longer hide the fake cash. He could no longer convert it into real assets, and he could no longer generate enough genuine profits to fill a hole that had taken years to create. For the first time, the fraud had nowhere left to go. Only one option remained: tell the truth. The failed Maytas acquisition changed everything. For years, management had successfully controlled the narrative. Now, the market no longer trusted them. Every financial statement, every reported cash balance, every quarterly result came under intense scrutiny. Inside the company, Ramalinga Raju understood something devastating. The fraud had reached a point where it could no longer be hidden. There was no realistic way to generate enough genuine profit to replace the fake profits accumulated over nearly a decade. The gap had become enormous. According to his later confession, Satyam's balance sheet overstated cash and bank balances by more than 5,000 crore rupees. Accrued interest that had supposedly been earned also largely did not exist. Debtors had been overstated. Liabilities had been understated. Even operating margins had been manipulated to make the business appear consistently stronger than reality. Notice what had happened. This was no longer one accounting adjustment. Every major financial statement had become interconnected. The income statement depended on fake profits. The balance sheet depended on fake assets. The cash flow statement depended on imaginary cash. The interest income depended on imaginary deposits. The company had effectively become financially self-referential. Each financial statement validated the others, but all of them depended on one assumption: that nobody would independently verify the underlying cash. By early January 2009, Raju concluded there was only one remaining option: continue the deception and risk an even larger collapse later, or admit everything. On 7 January 2009, he sent a confession letter to Satyam's board. The letter contained one sentence that immediately entered corporate history. It was like riding a tiger, not knowing how to get off without being eaten. Within minutes, financial markets understood what had happened. One of India's most respected technology companies had never been as financially successful as it claimed. The fraud was finally over. The collapse was only beginning. The confession triggered immediate chaos. Within hours, Satyam's share price collapsed. Billions of dollars in market value disappeared. Global clients questioned whether critical software projects would continue. Banks reviewed their exposure. Employees feared they would lose their jobs. For the Indian technology industry, the crisis was far bigger than one company. India had spent decades building a reputation as a trusted global outsourcing destination. Companies around the world had outsourced banking systems, telecommunications platforms, insurance software, government projects, and enterprise technology to Indian IT firms. If confidence in Satyam spread to the entire industry, billions of dollars in future contracts could be at risk. The Indian government moved unusually quickly. Within days, the existing board was dissolved. A completely new board of respected business leaders was appointed. Their first priority wasn't maximizing shareholder value, it was keeping the company alive. Employees had to remain at work. Customer projects had to continue. Payroll had to be funded. Clients had to be reassured that software delivery would not stop. The operational business had to be separated from the accounting fraud. That distinction proved critical, because despite the fake financial statements, Satyam still employed tens of thousands of highly skilled engineers. Real customers still depended upon its software. The business itself retained significant value. The challenge became preserving that value before panic destroyed it. After months of stabilization, the government organized a competitive bidding process. In April 2009, Tech Mahindra agreed to acquire a controlling stake in Satyam. The acquisition saved thousands of jobs, protected customer contracts, and restored confidence that the business could survive. Unlike many accounting frauds, Satyam did not disappear. Its ownership changed, its leadership changed, its governance changed, but the software engineers, the customers, and much of the underlying business continued operating. The company had survived. The credibility of its financial reporting had not.
Satyam's collapse permanently changed corporate governance in India. The fraud wasn't the largest in history, but it exposed something far more important. Even a profitable, globally respected, award-winning company could deceive investors for years if governance failed at multiple levels simultaneously. Management failed. The board failed. Internal controls failed. External auditing failed. Investor skepticism failed. Each layer relied upon another, and because every layer trusted the previous one, the deception continued almost uninterrupted for nearly a decade. The scandal triggered sweeping reforms. Corporate governance rules became stricter. Independent directors faced greater responsibility. Auditing standards were strengthened. Financial reporting received greater regulatory scrutiny. Companies could no longer assume that reputation alone created trust. Trust now required verification. For Satyam's employees, the outcome could have been catastrophic. Instead, the rapid government intervention and Tech Mahindra's acquisition allowed tens of thousands of highly skilled engineers to continue serving global customers. The business survived. The financial illusion did not. Today, the company operates as part of Tech Mahindra. Many of the software platforms, customer relationships, and engineering capabilities continued long after the fraud ended. Ironically, Satyam never collapsed because it couldn't build software. It collapsed because management tried to build financial success using accounting entries instead of genuine performance. The real company was actually strong enough to survive. The fictional company reported to investors was not. Satyam became one of the world's clearest reminders that accounting does not create value, it only reports it. The moment financial statements stop describing reality, every business decision built upon them begins moving in the wrong direction. In the end, Satyam wasn't destroyed by technology, competition, or customers. It was destroyed by numbers that never should have existed.